the most no-nonsense logo, Texas Instruments Incorporated. Now, I love this company. It is one of my favorites. This will be the 41st company in the 2022 season valuation rankings. Try to guess as we go along what ranking this is going to get. My favorite company, hopefully it ranks at least decently high. Otherwise, I'm going to have to reevaluate some things. Timestamps are in the description if you want to skip ahead. All my videos are designed for you to navigate as you please. Let's dive in so that your wisdom can blossom. Let us find this item 8. Oh, come on, guys. My favorite company is making me look bad. There's no links. I'm having to scroll. Still scrolling. A very unattractive annual report so far, just in terms of presentation. But look at this revenue growth. More importantly, look at this gross profit growth. You are absolutely going to calculate the margins here. And if you do, you're going to see 14 out of 20 is higher than 9 out of 14. This is an increasing gross margin. Mwah. Chef's kiss. All other costs are just rock solid steady, leading to just making billions of dollars more compared to 2 years ago. Moving on to the balance sheet. Short-term investments, let's just gloss over this. Nobody's perfect. Their total assets are at about 2.5 total liabilities. We would call this a little bit extra safe, but not crazy. Retained earnings in the tens of billions of dollars. I mean, just very few companies ever reach these highs. I love it. Moving on to the statement of cash flows. How is this depreciation so low? I mean, at this point, I'll remind everyone that Texas Instruments is often shortened to TI, and I'm including this in some of my high-profile companies. It's being released on a Tuesday because how many people have used TI calculators throughout high school, throughout university? Very few children in our generation get by without interacting with TI calculators. And yet their depreciation's not even a billion. The bottom of their income statement is 8 times higher than this depreciation. Now that is funky. How are they doing this? We're going to find out in a moment. Stock compensation is very tame, and they don't even call it stock-based compensation. That extra based is too frivolous for this company. This no-nonsense company just says stock compensation. Take it or leave it. All right, from the opening move, I mean, we gotta ask, how do you have depreciation that is this tiny when your income is this big? Let's go to the notes to depreciation. The more time I spend with this annual report, the more I really wish they would just include links. Very embarrassing that I said it's my favorite company, because it is, and it doesn't even have links. Yes, I'm still scrolling, guys. Most of this video is going to be just scrolling. I did eventually remember that it has been a minute since I've done this, but that back in the day I used to just Control F search for the things I'm finding for. I don't need to scroll. Never had to scroll. Bit silly of me to scroll for as long as I just did. I am looking up capital expenditures because that is what leads to depreciation. I will buy equipment this year for, let's say, $2.8 billion, like they listed here. That will show up as less than $2.8 billion in expenses this year, but then it'll also be an expense next year and 3 years out. And depending on specifically what it was, depreciation will last for a while. Here, there is an explanation. We continue to invest to strengthen our manufacturing and technology as part of our long-term capacity planning. Our capital expenditures are expected to be higher than historical levels. Now, higher than 1/8 of net income, I think you're going to be okay, guys. I think it's going to be fine. In August of the year of this report, 2022, which is the latest report, there was some U.S. legislation which provides funding for manufacturing grants and research investments, as well as very sizable, 25% is nothing to scoff at, investment tax credits for certain U.S. semiconductor manufacturing facilities. We expect to receive the cash benefit associated with the investment tax credit in future periods. To put that into context, Texas Instruments has to have a whole section devoted to government incentives. Incentives related to the acquisition or construction of fixed assets are recognized as a reduction in the carrying amounts of the related assets and reduce the depreciation expense over the useful lives of the assets. In other words, Texas Instrument just explained that they spent about a couple billion in setting up semiconductor facilities. That's capital expenditure over the last couple years. That's showing up as a little bit less than a billion on the cash flow statement. The only thing I'm finding in this entire report that explains the gap between we spend, say, 6 billion, but our depreciation is less than a billion, is the reduction in depreciation expense provided by government incentives. And so I can't say for certain, based on what I'm seeing in this annual report, that the entire gap boils down to tax credits and grants, which were what the government incentives they described were. But guys, this company purchases factories for billions and billions and billions of dollars, yet their depreciation has not, over the last 3 years, even been at a billion. This is an extremely good position. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. The government is supporting their investing. Cost of revenue is mainly the raw materials that are input in order to create wafers and overall semiconductors. It would also include the depreciation. Now, depreciation, the actual building of all these factories, is less than a fifth of each one of these years. Here we have 6.2 billion for the latest year, and if we scroll down to cash flow statement, we can see broken down that 0.9 of that is depreciation. To put that into perspective, that is a little more than 10% of all cost of revenue on a 70 plus gross margin business. In other words, that is about 2% of the revenue they take in, is what they're depreciating for building the whole factory. This would be at like if Ford, the car company, only had to pay 2 cents for all the equipment in factory needed to make cars every time that you bought $1 worth of their car. 2 cents, guys. 98 cents of every dollar you spend on your car would be available for the marketing, for the research and development, for paying competitive wages, or just pure net income. Now we're looking at about a 40% net income margin here. Roughly 40 cents of that dollar you spend is just pure profit for the owners of the capital. And a lot of it comes down to government incentives. I can't say exactly how much. In fact, maybe they themselves aren't really incentivized to ask how much. Why is this happening? Well, whenever you get benefits from government grants or from the tax code, the economic reasoning is that you're doing something that these governments find to be a societal plus. And so, what is it that Texas Instrument does? Well, they do something that the government really, really, really appreciates. I mean, this is about as appreciative of a government relationship as I've been able to see them. But our government leaders, this is a US company, so US government leaders are basically pretty sure that the legislation they're putting out, that this is the right way to spend taxpayer money. Let's understand more about what it is that their product is. I've transitioned over to the item one and found a section called markets for our products. 40% of their revenue comes from the industrial market. Let's pay attention to some of the thing here is keeping in mind that what's happening here from an economics point of view is that as a society, we really want Texas Instruments to be having a very easy time of doing all these things, right? Now, they're creating chips and semiconductors for factory automation, grid infrastructure. That's one of the things we were looking for. Medical, another thing we were looking for. Building automation, test and measurement, aerospace and defense. There we go again. Appliances, motor drives, power delivery, very important. Pro audio, video, and signage, industrial transport, and then it continues like this. Then we get to just the automotives. Now, they're providing parts, semiconductors for the infotainment in your car, the powertrain systems in your car, the advanced driver assistance systems, the body electronics, and just safety features. I mean, the safety features in your car rely on the bits and pieces that these guys manufacture. And moving on to the personal electronics, this is now where you can see that they're building a more consumer type business. Arguably, I'm kind of making this up a little bit, but If they only did this personal electronics, there's many companies like Intel, for example. Check out my video on Intel to get more information about what would be a direct competitor to this. Basically, a similar thing, but more focused on personal electronics. If Texas Instrument were only focused on personal electronics like Intel, they probably would not be benefiting so much from government incentives. All of those things, and then you look at the grid infrastructure, that's why this company is so supported by every taxpayer of the US economy. If they can do a good job, lots of people get benefit from grid infrastructure. And I really, really want to stick on this point because this is my favorite company because of this very reason. As an investor, obviously you could look into, I'm going to give this company money, and so is the government. And I kind of benefit from the government helping this company out. Now, yes, you benefit from this company helping out, but Texas Instruments is doing things like grid infrastructure for a price that is not reflective of the value that they're providing to society. In other words, they're not going to charge what it really costs in order to keep medical and grid infrastructure. Now, to be fair, are they going to charge a lot of money? I'm sure they will charge a lot of money because they produce high quality products, and a lot of them, right? But compared to everyone who benefits from hospitals working and everyone who benefits from grid infrastructure working and aerospace and defense working, all the people that benefit from this do not give them revenue. Instead, the government makes it economically viable to not charge what would be like a quote unquote ideal fair price by showing up as reduced depreciation expense. Really, this company, I think it had about 20 billion in revenue in the year of this report. Everything that this business does, in the ideal world, they would, yes, have higher costs of revenue, but also that would be balanced out by having higher revenue than what they're able to charge because of the nature of the common goods problem type things that they do. We could imagine that maybe they should be charging 25 billion or 30 billion this year by doing the exact same things. Government legislates, and Texas Instrument is able to win contracts and grants, do a lot of correct things in order to collect these grants. It's definitely not free money. This is a weird concept, so I'm going to go back to the income statement just to really highlight what's going on here, because my favorite company is a bit in a weird position. You could easily miss this as a financial analyst. This is something you have to be very aware of in order to realize, right? So what I'm saying is that this right here, in the perfect world, be say 25 billion instead of 20 billion. But the cost of revenue would not be decreased by government grants. And I'm going to make the claim that it might not be perfect, roughly what it should be. And so this cost of revenue without government incentives would maybe be 11 billion. And so you would end up with a lower gross margin, but the same amount of economic activity happening. Exactly what makes this my favorite company is that for the level of economic activity that they're doing, gross profit margin is actually boosted. If nothing changed about this business, but we could turn on a quote unquote fairness switch and stop the government involvement, make this more laissez-faire, but fairness in revenue, they would have the exact same similar, but their gross margin would just be less. That's crazy to me. Texas Instruments will always have a higher gross margin. And what does higher gross margin mean? Well, it means flexibility in capital allocation, dividends and share buybacks. And that is exactly what Texas Instrument has done historically. Other parts of this annual report, which I'm tired of scrolling, so unfortunately I'm not going to go back to, but I did read just now, show that Texas Instrument is just doing their best that they can to make semiconductors. And then they spend all their time focusing on share buybacks and dividend increases. That's a great business, guys. A business that can do the exact same things as its competitors and yet be rewarded with ample opportunities to focus on rewarding investors is a more financially efficient business. Providers of capital for this business will have a shorter time to wait in order to receive reimbursement. The government is not changing the returns, but it is fast forwarding them. There's so many businesses that are given wonderful opportunities, some weird situation like this, but do not land the execution, do not stick the landing. This is an example of what it looks like when you absolutely stick the landing. 70+% gross margins in an industry where everyone is fighting for 40 to 60% gross margins. It's beautiful, guys. Absolute favorite company. For now at least. Were you able to guess the ranking of my favorite company on the 2022 season valuation ranking? Please like, subscribe. Tell me information about other government grant programs that you're aware of, other companies that benefit from government grants. That would be really, really fascinating because these businesses are just, again, so much quicker. It's such a cool way to benefit society, to make money. Please share your stories, share your comments, share your wisdom, and share this video. Texas Instruments TXN is ranked 7 out of 41 in value for the 2022 season. Very solidly in the top 10. Being in the top 10 is impressive, I have to admit. And the only reason TXN is not higher is because of its relatively kind of high price. You know, it's not a cheap stock by any means. This is not investment advice, but if you talk to me about this company, I'm pretty much always liking it.